Welcome everyone. Welcome back to the Microstructure Exchange. Great to see everyone again after the break. So today we have Zhenkai Ran and Mao Ye is also here for an interesting paper on a link between microstructure and climate finance. Before we give Zhenkai the floor, it's a new season and slightly new rules. We will now it is possible to simply unmute your mic again. You don't need to ask for our permission by raising hand or something. And we hope that will allow for more discussion in the sessions. Other than that, it will be very similar to the previous seasons. For this session, Zhenkai has said that it is fine to ask questions at any time. So if you want to interrupt, then you can raise your hand, or raising hand is probably the preferred way. And for clarifying questions, we have Mao in the chat who can take those anytime as well. I think that's all for me, and I give the floor to Zhenkai.
Thank you, Bjorn. Let me share my screen. Okay, so first of all, I would like to thank the committee member of Microstructure Exchange for including our paper to this spring season of seminars. It's my great pleasure to be able to present this paper at this seminar, and it's a joint project with Mao Ye. So what we're trying to do in this paper is we try to leverage a shock that happens in the financial market structure side of the market to try to address the challenge that in the climate change finance. So what the background of this climate finance challenge is that in Laura Stark's AFA, she presented a challenge that there is a group investor in the economy called the green investors. They try to make investment into those green stocks. So it shows their strong preference to those green stocks. But even within this big umbrella of green stocks, there are two big groups of investors. They make their green investment out of completely different incentives. So one big category is the values investor. They tend to hold green stocks out of their non-pecuniary preferences. So they are the ones not willing to supply capital to those firms associated with objectionable behavioral products. And when it comes to be a trade-off between financial performance and environmental performance, they are willing to sacrifice some financial returns to achieve their environmental agenda. So in other words, they tend to have a high willingness to pay for their environmental objectives. And on the other hand, there is another category of investors called value investors. They try to incorporate this ESG factor or environmental performance of the firms on the basis that they can improve their risk-return trade-offs. So essentially, they care about whether investing to those green firms can help them improve their risk-adjusted return at the end of the day. So they really have low willingness to pay for their environmental objectives. And it's important to disentangle those two groups of investors at this stage of literature, because it's in the interest for the policymaker, for example, to understand the relative role played by each group of investors in driving the corporate environmental policies and eventually driving the green transition, so that, for example, they can come up with more tailored policy to incentivize one group of investor and also another tailored policy to incentivize another group of investors. Okay, but it's especially challenging to disentangle those two groups of investors. The first reason is the asset managers with a low willingness to pay, or the value investors, they tend to have low incentive to disclose their true incentives or their true willingness to pay. Okay, because for example, disclosing their true willingness to pay may harm their reputation perceived by the retail investors and eventually harm their fund flows. The second reason is, second challenge is that we cannot really rely on some self-reporting measures such as ESG mandate. For example, asset managers can strategically use this ESG mandate to advertise themselves without actually giving up returns to make sustainable investments. And there's study by Baker showing that funds with and without a ESG mandate can actually hold very similar portfolios and achieve very similar realized returns. And finally, another challenge is that one may think of measure the willingness to pay using some asset pricing models. But at this stage of literature, is no consensus regarding what's the correct asset pricing model to actually compute the risk-adjusted willingness to pay. Okay, and this also explains why there is booming the number of asset pricing papers in the past decade on pricing climate change. Okay, and we try to use this. We use this TIXA pilot to address this challenge. And the pilot is that SEC randomly selected about 1,200 stocks to be the treatment firm and 1,199 stocks to be the control firm out of a universe of about 2,400 small and medium-sized stocks. And it's a pure nature experiment. So what SEC did is it increased the tick size at which you can quote the trader stock from 1 cent to 5 cents for the treatment firms. And the tick size for the control group, it remained the same at 1 cent. And the total duration of this pilot is 2 years' time, from October 2016 to September 2018. And why do we think this pilot can help address the challenge in the climate finance literature? It's because of the following reason. First reason is a nature experiment. So it exogenously increased those investors' transaction costs when those investors try to exert governance over the firm. And then there is no actually a precise threshold to perfectly disentangle value and values investors. There is no such a precise threshold in the world, but we believe this 4% increase in the transaction costs serve actually as a very good benchmark and a conservative benchmark to disentangle those two groups of investors. Because the values investors tend to have a high willingness to pay, they should not really be constrained by this only 4% increase in their transaction costs. And on the other hand, those who responded to this 4% increase in their costs, they should have a low willingness to pay, and there must be value investors. And we are not arguing all the value investors will respond, but our argument is those who responded to this pilot, they must have a low willingness to pay. Okay. And a final reason is it's also an advantage. We do not rely on any asset pricing model or risk assumptions about the investors. Okay. So just as a roadmap and a preview of our main results, we first show that during the pilot, the treatment firms experienced a significant decline in their environmental rating, and also they tend to emit more during the pilot, and their emission intensity also goes up. And we find that the exit-based governance seems to be the main driver of the results. So during the pilot, when it's more costly for you to exert a credible exit threats against the firm, this effectiveness of exit can be diminished. So this can explain why there is a decline in the environmental rating amongst the treatment firms during the pilot. And this is based on two pieces of evidence. The first evidence, we find that the pilot reduced the intensity of divestment of those green investors in response to the environmental incidents. And the second piece of evidence is based on firms' sensitivity to divestment. So we find that firms with a higher excess threat exposure ex ante tend to experience a larger decline in their environmental rating because there is a bigger power vacuum once pilot has become effective. And we found a complete reversal of the results when the pilot has concluded in 2018. Okay. And we contribute to literature on three perspectives. First is we show that we can use exogenous liquidity shock to identify the influences of value investors. So this contribute to try to address the challenge postulated by Laura Starks. And then we also contribute to the governance literature or the X literature. So past the X literature try to identify the causal effect of exit on firm performance by using liquidity as a shock on the effectiveness of exit. But they only show it by showing what is the effect of liquidity on firm performance depending on firms with different exposure to this exit. But these are only indirect measures. We show direct evidence showing that the liquidity can affect the actual divestment decisions made by the investors. And finally, we also contribute to showing there is a positive causal effect of liquidity on ESG. So we contribute to the debate on whether it is the greenness of the firm driving liquidity or is the other way around. For example, United Nations conjectures that the stock exchange can improve the ESG performance through improved liquidity. But if you just run naive tests, it can suffer from severe reverse causality issues. For example, green firms are simply bigger and then they can be more liquidity traded. Okay, so that's the our main result and the contribution to literature. So we first try to show our result by identifying what's the effect of TICSAT pilot on environmental rating. We adopt the standard different difference approach. We measure the environmental performance of firm using the MSCI AVA score. This score ranges from 0 to 10. And we use this MSCI AVA because this ESG rating agency has the largest coverage of firms in the world, and also is most frequently updated, has low noise based on Anna Pavlova's paper in 2022. And also we include a set of treatment firm indicators and the treatment period indicators, and also include a set of control variables based on the past literature alongside with firm fixed effects and time fixed effects. Okay. So the first baseline result is that we find during the pilot, the treatment firms experience a decline in their environmental rating, which amounts to about 0.13 points. And this decline in their environmental rating is only start to kicking off once the pilot has started. So there is no pre-trend before pilot started. Okay. And then we do further rigorous causal inferences by looking at utilizing a feature of the pilot that this increase in tick size from 1 cent to 5 cents is universally applied to all the treatment firms, regardless the size of beta spread before pilot started. So this new tick size should serve as a more binding constraint for firms with started to be traded with a small beta spread. For example, if a treatment firm started with a beta spread of 1 cent, once the pilot started, their new beta spread will be binding at, for example, 5 cents. But this is not the case for firms started with about 10 cent beta spread. And this is also consistent with Albuquerque, Song, and Yale's paper showing it's amongst those small spread firms, they documented the larger decline in their stock liquidity. Okay, so we follow their approach. We divide our sample into two groups. First is if they are small spread. Second is if they are large spread firms. And we use a cutoff point of 3 cents. So if a firm has an average dollar quoted spread smaller than or equal to 3 cents during the pre-pilot time, they are classified as a small spread. And we show that the decline in the environmental rating among the treatment firms is mostly concentrated among the small spread firms. So this speaks to the direct and causal effect of liquidity on the environmental performance of firms. Okay. And we also show that the dynamic effect of the pilot, we show the effect is only start to kicking off once the pilot started, and there is no obvious pre-trend before the pilot. Okay. So after showing there is a first order effect of liquidity on the environmental performance, we now investigate why that's the case. We investigate mechanism. So we resort to the corporate governance literature on how liquidity can facilitate the governance exerted by institutional investors. So we first test the exit theory. So the higher liquidity should help facilitate the institutional investor to exert threat of exits. So what is this threat of exit? So if the institutional investor, if they disagree with the manager, they can threaten the manager to exit the firm and dump the shares. So in anticipation of this exiting threat or actual consequence of exits, the managers will start to be well behaved in the first place. So this effectiveness of exit really depends on how credible their exit threat is, right? If there is a negative event happening in the firm, those institutional investors should credibly exit. So the effectiveness of exit really depends on two factors. The first factor is the institutional investors' own incentive to exert credible exit threats. The second is whether the firm is having different exposure to such exit threats. We now first test the factor one. We'll test factor one by testing two questions. First is whether the investor will divest in response to an environmental incident. We first classify investor based on their portfolio level environmental rating. So if a portfolio level environmental rating is above the sample median, we classify them as a green investor. So this is also a review preference approach. And the second question we test is how tick size pilot has constrained such divestment intensity. Okay. We'll test this factor one by using the following regression, and this is investor firm quarter regression. So the dependent variable is the portfolio weight of a firm in an investor's portfolio at time t+1. On the right-hand side, we'll have the green investor indicator. We'll have the treatment firm indicator, treatment period indicator. We also have a dominant variable indicating the environmental incident. So our variables of interest will be beta 6 and beta 7. The beta 6 captures how green investor will divest following an environmental incident, and beta 7 capture whether this pilot has constrained this divestment intensity. So if exit is a driving story, we should expect a negative beta 6 and a positive beta 7. Okay, and that also seems to be what we find. We use 3 different windows to capture the occurrence of environmental incident. We find that once there is an environmental incident going on with their portfolio firm, a green investor tend to divest following the incident by reducing their portfolio weighting by about 2.6 basis points. Okay, and then we show that once the pilots start to become effective, this divestment start to be constrained. Okay, so this directly speaks to how the pilot has making green investors credible threats less credible. Okay. And then our story is that if anyone who has responded to this pilot,
sorry, Zhenkai, maybe do you think this is a good time to see if there are some questions?
Yeah, sure, yeah.
So if you have any questions, please raise your hand. And while waiting for that, let me take one question. I was thinking about the economic significance of your results, and as microstructure researchers, we of course like to see that there is a big effect of microstructure. But when you said in the introduction that the tick size pilot leads to emission levels increasing by 9%, if I got you right there, and that sounds like a very, very strong effect, unexpectedly strong. Can you help us to put this in context? Talk about the economic significance of the result?
Well, I think this speaks to the difference between the direct effect of the increase in tick size on the cost of capital of the firm itself, and then the effect of pilot on the corporate governance effectiveness exerted by the investors. So Albuquerque, Song, and Yao show that once the pilot started, there has been a decrease in the stock prices of treatment firms. And we find that that does not help explain the decline in their environmental rating. So which is true because the size of decrease in the price triggered by the increase in the tick size is not economically significant enough, but it is significant enough to influence the green investors' incentive to exert excess threats. I think that's the big difference. So if the investor perceive this increase in tick size is large enough, there will be a power vacuum within a firm. So if now the excess threats made by those investors become no longer credible, they will start to adopt policies that is, for example, no longer green anymore. I think that can help expand the results. And also, in the emission data we collect from EPA's greenhouse gas protocol, so they have quite a limited sample size, so that may also help explain the difference. So we find a relatively minor effect for the environmental rating, but bigger effect for emission level, because for emission levels, we focus on more limited sample.
I see.
Yeah.
Okay, we have a question from PK.
Yeah, thank you. So a very interesting paper. I wonder though that aren't these green investors, they might have already divested, right? Because it's a long-term decision. It's not you're depending on the transaction cost. So can that mute the effect after the pilot? Because pilot is again a specific period you're looking at. And perhaps it's possible that by that time, green investors already divested if they had.
Well, if the green investor do for example, a negative screening approach, a positive screening approach, they have already excluded those firms from their portfolio. Well, that should only make our result more conservative. Our argument is, if they happen to hold a firm that encountered this environmental incident, they should make a credible exit, right? So whenever there is a bad event going on with firm on environmental policies, if they are really green enough as an investor, they should exit the firm to show their commitment to their, for example, fund mandate.
Asking how will they exit if they already exit before this, right? So now they're non-green investors in the firm. That's why the effect might be muted. Anyway, I'll shut up.
Yeah.
Thank you.
Yeah, sure.
The PK, I think you raise a great point. It's like there are two possibilities. Number one is they do not respond. Number two is they cannot respond. We should consider two possibilities. It's like a value investor in our shock, maybe they don't respond to the shock. They do the same. That's one way we see the result. But you raise a great point. Since I'm a value investor, I have already divested so many firms. So when something happens, I just cannot respond. Right. So yeah, that's a great point. Yeah.
Okay. I think that can help answer the questions. So back to our story. Our argument is, if anyone who has responded to this pilot, it should be the value investors. The values, they may stay intact, but they will only make our result more conservative. Okay. So as just an external validity check regarding my argument that we have identified value investors, we now run investor level regressions. We classify a green investor as a value investor if they divest following an incident, but then they have their divestment intensity constrained by this pilot. So they have a negative beta 4 and a positive beta 7. And then we test this validity by looking at what is the chance of being a value investor and also being a norm-constrained investor. Right? So in the past literature, Hong Kachberzik and Barber, Morse, and Yasuda, they show that if an investor is norm-constrained, for example, as a public pension or as a bank or insurance companies, they tend to have a high willingness to pay because they have diverse constituencies, and also they tend to subject more to public scrutiny. So we check, is it more likely or less likely for a value investor to be norm constrained? So our null hypothesis is that if our method is just to randomly split the investors, we should expect no difference. We should expect that our value investor does not have any predictive power. That's not the case. So we find that within the value investors category, About 23 of them are norm constrained, but among the other green investors, 37% of them are norm constrained investors. So being a value investor significantly predict that you are less likely to be norm constrained. And this pattern is also consistent once we break down the norm constrained investors into its subcategories. We find that bring value investors tend to be less likely to be a bank trust, a public pension, and a miscellaneous type of investor. And also, on the other hand, there are also another group of investors, they tend to care more about financial payoffs of their investment. For example, their career outcome of those asset managers tend to be more positively correlated with their financial performance. Then we show that actually, indeed, the value investors tend to be more likely to be the investment companies and the independent investment advisors. So I think this result collectively provide a validity check regarding whether we have identified the value investors and also identified the value investors' influence over those corporate environmental policies. Okay. And then after testing the investor level behavior change, we're now testing our second factor, which is whether a firm with higher ex-ante exit threat exposure will experience a larger decline in their environmental rating. So a firm with higher exit threat exposure, they will tend to experience a larger power vacuum once the pilot started to become effective. And then we use two proxies for this exposure. The first proxy is whether the manager has their personal wealth closely tied to the equity prices. The second is whether it's hard for the institutional investors to effectively coordinate on their trading and voting behavior. Okay, we adopt a measure from Alex Edelman's work in 2009. We classify a group investor as a high wealth performance sensitivity if the firm fall into top tercile of the sample. We show that firm with high managerial interest equity prices tend to experience a larger decline in their rating, up to about 2 points out of 0 to 10. Okay. Now, second measure is on coordination risk. So according to Crane and his co-authors in 2019, they show that if it's hard for investors to coordinate well on their trading, then investors will, if they disagree with the manager, they will try to dump the shares before other people do, because they don't want to dump shares at a lower price. And we use adopter proxies, for example, we use total click ownership and the top click ownership as our first two proxies for this coordination risk. It captures what is the percentage of ownership owned by the investor click in the firm. If there's low click ownership, we're assuming it's hard for them to coordinate. And also, we also use our third measure to capture what is the dispersion of opinions amongst the institutional investors on the environmental issues. So if a firm is held by institutional investors with significantly different portfolio level environmental rating, we're assuming they have quite a difference in their opinion regarding how to influence the firm corporate environmental policies. So we measure this using the holdings weighted standard deviation of environmental rating amongst the institutional investors. And we found consistent results. We find that a firm with a higher coordination risk tend to experience a larger decline in their environmental rating during the pilot. Okay. So if we put those two pieces of evidence together, we have shown that access seems to be the main driver of the observed decline in their environmental rating, because the pilot had not only reduced the investors' own divestment credibility, but also we find that firms with greater sensitivity to this access threats, they tend to respond differently to this pilot. And then if this story is true, then we should find a reversal when the pilot has concluded. And that seems to be what we find. We find that if we move to a sample period where we testing what's the effect of lifting the pilot, we're comparing the post-pilot period to the pilot period. we find that well, during normal time, green investors tend to divest in response to incident, and once the pilot become lifted, they tend to significantly increase their divestment intensity. Okay. And then we also find a reversal in the environmental rating. So, for example, we find that firms with high exposure to the access threats, they tend to improve their environmental rating once the pilot has ended. Okay. As the final part of my main test, we also show the real effect of this pilot. So we collect data from the plant level database published on EPA. So they are required to be reported by the plant whoever emit more than 25,000 metric tons of CO2 each year. So this gives us very limited sample, but even within this limited sample, we find significant results. We find that during the pilot, treatment firms increase the emission level by as high as 9%, and the emission intensity go up by 7%. But once the pilot has ended, we find a reversal. Okay. So just to summarize what we have gone through, we have shown pilot can reduce environmental performance, and access seems to be the main driver of the results. We now move on to robustness checks. We check whether an alternative governance channel could be expanding the results, which is the voice. And also we show whether the TICSA pilot's direct effect on cost of capital would expand the results. And then we also try to quantify the effect of liquidity on environmental performance using 2LCRS. And finally, we check our results using alternative control group. Okay.
Maybe it's time to take some questions, I think.
Yeah, sure. Yeah.
Yeah.
Are there any questions at this point?
I guess maybe one question I could have is what does the
go ahead.
timeline look here? If we think about starting in 2016, tick size pilot starts, ends 2018 or whatever that 2-year period is for like the emissions.
Yep.
How fast is this liquidity effect impacting investor or manager behavior? Then how fast does that turn into emission changes? How fast does the pattern reverse? You give kind of a timeline there.
So we in our main regressions we use a quarter level regression. So but then in our dynamic effect graph we use the yearly dummy variables to indicate whether treatment comes into effective. So we can show the effect comes to be effective once the pilot started in the first physical year. But then we can first certainly break down into smaller time period by breaking down into physical quarters. And I think the effect only starts to take off once you go on through, once the pilot started for about 2 or 3 quarters to become fully kicking to affect the policies. And for the emission level data as well, the emission level are reported on a yearly basis. Not like environmental rating, which are reported on quarterly basis. So based on a yearly basis result, we find significant results, which is consistent that it takes time for managers to start to change the policies upon having a shock in their firm. Yeah. But that's a good question.
So Yushin, go ahead.
Right. So I think one of the underlying assumption here is that with widened tick size, values investors are harder to exert an active threat. So can you explain more about the intuition behind this assumption? Why? I mean, if a value investors really don't like this firm, they would exit whatsoever, regardless of the tick size constraint.
Yeah. So we're arguing this. Whoever who responded to the pilot, they must be the value investor, have their access threat constrained. The values investor, well, they can still divest, but it will only make our result more conservative. And it's also possible that the values investors tend to maybe rely on voice to influence the firm rather than exit, because if you do voice, you can make your action publicly observable. It can help you attract more the fund flows from the retail investors who tend to have more non-peculiar preferences regarding this issue.
Okay, so is value investor really driving these results?
At least for the exit-based governance.
I see.
The exit is the value investor, the ones who are sensitive to the financial payoffs of their investments. Yeah.
I see. So, but I mean, by value investors only care about their financial return, why should they also care about their the firm's environmental scores? Why do you still observe the decline in the environmental score?
The trading-off between the cost of remaining in the firm and the cost of exerting governance, exerting access threat, getting out of the firm. Right. So if they remain in the firm, it have to suffer from the financial costs of these incidents. But then if they exert governance, they have to credibly exit by paying transaction costs. Right.
All right, thank you.
Any other question?
I don't see any other questions at the moment, so let's proceed.
Okay. So we now go on to the robustness checks. I think there is another question by Yasha.
Hey, sorry guys. I meant to ask this earlier. I was driving to work, so I couldn't. Really nice setup. I believe the results. I mean, empirical side. So one thing I meant to ask is when you talk about liquidity, it seems to be you're talking about the transaction costs of institutional investors. And so as I remember, I do not think there is work on tick size pilot that has established the effect on institutional trading costs. But then we have E10 and co-authors work that use the decimalization to sort of show that maybe tick sizes, at least suggest that tick sizes do not affect institutional trading costs. So I don't think that's a problem for you though. And the reason is, I think you can use the heterogeneous effects of the tick size on bid-ask spreads, effective spreads. So you talked about this cutoff of 3 cents, if I heard correctly, where you show the results are stronger. I think that's a good sign. So the other side where you could look at is that for stocks that had a pre-TSP spread of greater than 15 cents, the effect of tick size pilot are in the opposite direction. So basically, I would expect if your mechanism was working in the way that you would be suggesting, is that if you focus on the stocks with really wide spreads pre-tick size pilot, you would get the exact opposite coefficients all around. So that was my comment.
That's a very good point. I think that's well taken. We will check that in the follow-up work of our paper. That's a very good point. Yeah. Any other question? No? Okay, and then I can proceed. So we now go on to check.
Let's see the robustness checks, and then you can.
Yeah. So there is an alternative governance mechanism through which investor can influence the firm, and it's through voice, right? So if the manager misbehave, the shareholders can drive the manager out of the firm by voting it out. And we use 2 proxies for voice. The first is the activist campaigns on environmental issues, and second is the Schedule 13D filings. We find that in both cases, we find very low exposure of pilot firms to the voice or the activism on environmental issues. So for example, we find that during our summer period, there are only 2 environmental proposals, and not to mention they all failed. And this is consistent with the past literature showing out of past 1,700 proposals on environmental issues, only 15 have passed. And then a second measure is 13D filings. They are required to be filed if an investor first acquires at least 5% of share in a firm, and also with interest in influencing the firm management with the intention to do shareholder activism, We also find that out of 27 certainty filings made by green investors, none of them actually targeted the small spread firms where we observed the largest decline in the environmental rating. Okay. And we also look at certainty filings. Certainty filings is required to be filed if a share block is acquired without the intention of activism. And we do find results supporting implicitly the exit story. We find that the pilot has reduced the certainty filing intensity for the treatment firms. And once the pilot become lifted, we see an increase in the certainty filings. So if you acquire a share block in a firm without activism intention, then maybe one possible way you can do left for you to do is to exit threats. Okay, so this evidence also support implicitly the exit story. And as mentioned by Bjorn, that the tick size pad itself, the change in tick size is not significantly large enough. So this is reflected in a price decrease in the amongst the treatment firms on the enforcement day. So our Crookey, Song, and Yao show that there is such price decrease about 3%. So it's not economically large enough. So that's also consistent with what we find. We find that if we include this abnormal return around the TSP enforcement month, we find that does not help explain the decline in the environmental rating of the treatment firm. And we further include a set of proxies for the excess threat exposure. We find that our excess threat exposure remain robust in explaining the decline in the environmental rating. Okay. And we also try to quantify what's the effect of liquidity on the environmental rating using a 2SLS by instrumenting the liquidity measures using the Pixel pilot. So in our first stage, we show that consistent with past study, we show that once the pilot started, treatment firms experience an increase in their quoted spread and effective spread. And in our second stage, we find that we regress our environmental rating again as instrumented liquidity measures. We find that about for one standard deviation increase in the quoted spread, there tends to be about 0.44 score decrease in their environmental rating in the future. Okay. And also we show a consistent result using an alternative control group by matching our treatment firms with a universal firm of all the US public firms. And the result is concentrated among the firms with a small spread. Okay, so just to conclude, our main result is that we find pilot reduced environment performance, and access seems to be the main driver as it constrained the green investors' ability to exert credible access threats, and also firms with higher exposure to this access threats tend to experience a larger decline in their rating. And our main takeaways are, firstly, the microstructure matters for ESG. It's because we have the first paper showing there's causal positive effect of liquidity on environment performance, and also provide direct evidence that liquidity affects investors' actual divestment intensity, which the past exit literature did not show. And also we are first to identify the influences of value investors on corporate environmental policies. And I want to thank again for your attention, and I look forward for all the comments and questions you may have.
Thanks a lot, Zhenkai, for this very nice presentation. So let's proceed with the Q&A. Just raise your hand if you have any questions. Albert, go ahead.
Yeah, thanks, Zhenkai. There's lots of analysis you did, and I'm still trying to parse the mechanism that you have in mind. And one thing that was going around my mind is we're talking 2016, 2018. The whole ESG movement, I think, is of later years than that period. And when you said there were 2 failed attempts, and that sort of rings true to me because it wasn't so much of an issue that back then. As a matter of fact, maybe it was the time that it started to come up. And when you talk about exit, you emphasize on exit so much, and somehow something tells me it might be entry that might hamper these firms to do something. I mean, if you want to be an attractive firm for this type of investors, but now comes a period that it's really, really costly to enter for these type of investments because liquidity is poor, then you might not be incentivized to do anything and attract these people. Is this an alternative story in your mind? I mean, what are your thoughts about these things? By the way, very, very nice presentation.
So thank you for the question. So as you mentioned, the entry of investors can also be hampered. So that's relates back to our evidence on syringe filings. We find the syringe filings do decrease during the pilot and reversed once the pilot has ended. So that is consistent with story that the entry has been restricted for investors who want to influence the firm using exit threats, because we find certain defilings do not have very low economic significant power to expand the results. And also, as you mentioned, 2016 is also a period of time where the Paris Agreement is passed. So I think that will not like make a result problematic, because pilot is the TICSA pilot is a natural experiment. It randomly selected the control group and treatment group. If the Paris Agreement is driving the results, then we should not find any difference between the two. But we do find a significant difference in the environment performance across two groups that were randomly selected.
And so this is clarifying. Then do you see opportunities to distinguish these two? Like it's the incumbent shareholders' inability to effectively threaten with exit, or if it's a barrier to entry of new firms that might govern that might exert that might basically incentivize firms to change their policies. Do you see a way to distinguish these two effects, or they're not the same, right? If I understood you correctly.
So I think the idea is that if the investor wants to come in to influence the firm, they want to influence firm in one of the two ways. One is voice, another is exit. So even once it comes in, they still have to influence the firm a certain way to make change regarding firm policy, either through activism or through exit. So we do find that there is decline in the block acquisitions for those people without an activist intention, which left them with no option but using exit threats to influence the firm. So I think on the exit level, I think exit can expand the results. But regarding the new shareholders or the existing shareholders, we cannot fully distinguish the two, right? Because that's the counterfactual case. But we do find the existing shareholders, their ability to exert exit threats has been constrained.
Thanks. Either Mao, your co-author, in this room,
yeah.
or he's
Yeah, Albert, but because you asked such a great question, let me try to add some points. Zhenkai have already said something. I definitely agree with you. It's equally important for somebody to enter, to buy. That's also important. Let me tell you one challenge. Actually, that's the whole challenge for the literature. We solve one issue, but there's still one thing remaining. It's like when they buy, it's very hard for us to link why they buy. So when they exit, it's probably easy for us to document that we can explain why they exit. So actually, we only solve half the problem. The whole literature of liquidity and corporate governance, they do not, in the past, it's even hard to show why they exit. For example, you are not happy about the CEO of a company, but then some firm divest. You don't know whether they are unhappy, about their CEO. So environmental is a special case when something happens and you see divestment. So then we can link the actual exit with the portfolio manager's action. Here is a robustness check because we see the effects buy, basically they acquire. But to further know why they buy is a big challenge. That's the first point. And also you mentioned it's 2016. That's actually relates to Beyond's question. The effect actually is big. The gap is, even if there's a parallel trend, but the treatment effect may depend on the environment. Probably that's the time when environmental issues becomes very sensitive. That part I agree. And also for Beyond's question, why the impact is big, let me explain to you. There's one reason. It's like so for firms who provide emission data, they are extremely sensitive. There's a certain kind of selection bias in this issue. So firm who so that's the reason. It's like emission level, we have much less firm. It's a very small sample. Firm who publicize this data is a subgroup. Probably they are very, very sensitive. And when you amplify that with 2016, so we probably see a very big effect. So
Thank you.
Thanks, Mao. Before letting Yash in, let me do a follow-up question related to that. I saw in the emissions regressions that you have an R-square of 95% or something, which also surprised me that you can explain all emission variation with financial variables. Is the response to that similar, that this is a very special sample?
Well, we use, I think that high expansion power could be explained by including both firm and time fixed effects. So if
Okay.
we take out the firm time fixed effect,
that's my fault, because when we discussed that, I asked him to make the table bigger. So actually the fixed effect in the paper, you can see the fixed effect. I asked him to expand the paper to remove some variables. Yeah, their fixed effect so that everybody can see. That's my fault. Yeah.
Okay, next question is from Yash.
Thank you so much. Yeah, I was really intrigued by Albert's question, and I'm wondering if it would make sense for you guys to consider the following. So like if you wanted to get the entry effect somehow, maybe one way to do it would be to basically find firms outside the tick size pilot set controller treatment, and maybe try propensity score matching or some technique like that to identify firms that are similar to the firms that would be susceptible of this type of ESG effect in the treated group. And then, for example, look at the impact of the pilot on 13G filings. And my thinking is, if I'm an investor, I want to invest in such a firm, so I see a barrier in these treated firms, I go find something else. So think some sort of a spillover effect. That's another suggestion.
Yeah, that's a very good suggestion. So, any other questions?
So while waiting to see if there are more questions, let me announce that in 2 weeks, we are back at the Microstructure Exchange, and then we have Albert Menkveld as the presenter.
Yeah. First, I want to thank Albert to give this spot to us, actually. It's like, yeah. And also, if there's no further question, I want to address Tom Ernst's question about the timing.
Sure,
I think
go ahead.
it happens very fast. Let me explain to you. That also address Beyond's question, is like why effect is big. Here's one hypothesis. It's like maybe firm in the treatment group, they delay things. They probably when their treatment, they know it will be left. It's 2 years from now. So then they start to do something. But still, it's like we show it matters. And even if firms are willing to delay something, or they try to do something when they're in the treatment, that still shows like market microstructure matters. But it may possible to amplify the effect a little bit. That part I agree. Yeah.
Thanks, Mao. So last call for questions. I don't think we have any more questions. So thanks a lot, Zhenkai and Mao, for this interesting paper. Thank you everyone for coming. Have a great day and evening. I'll see you in 2 weeks.
Thank you.